Are you tired of watching your portfolio just barely keep up? Or worse, losing ground while the so-called experts tell you to just accept average? What if I told you that the common wisdom about beating the S&P P500 is fundamentally flawed, and there's a proven path to crushing it by 2026 that almost no one is talking about seriously? The market is a roller coaster, right? One day it's up, the next it's down, and you're left wondering if your hard-earned money is actually working for you or just getting tossed around. For years, we've been told to simply buy the index and settle for S&P 500 returns. And for most people, that's exactly what they do. They pour their money into passive funds, watch it inch up, then panic sell at the first sign of trouble. They settle for okay. But okay doesn't build real wealth. Okay doesn't let you retire early or buy that dream house or leave a legacy. We're here to talk about beating okay by a landslide, with a strategy Wall Street rarely champions because it's too boring, too consistent, and frankly, it doesn't make them quick commission fees. We're talking about the Dividend Aristocrats strategy for 2026. Now, don't just roll your eyes and think, oh, another dividend video. This isn't about chasing the highest yield and hoping for the best. That's a recipe for disaster. Most people trying to invest in dividends get it dead wrong. They look for the shiny, massive payout, ignore the underlying company, and end up with a portfolio full of value traps that cut their dividends and tank their stock price. They focus on the yield, not the sustainability and growth of that yield. That's why so many everyday investors get burned and then shy away from income investing entirely. They listen to the wrong gurus, follow the wrong advice, and assume dividends are just for retirees. But what if I told you that focusing on a specific, elite group of dividend payers can not only provide consistent income, but also outperform the S&P 500 over the long run, and do it with less volatility? This isn't just about income. It's about compounding wealth, stability, and intelligent growth. Let's clear something up right away. What even is a dividend aristocrat? It's not just any company that pays a dividend. These are the titans, the champions, the companies in the S&P 500 that have not only paid a dividend, but have increased their dividend for at least 25 consecutive years. Think about that. 25 years. That means they've weathered multiple recessions, dot-com bubbles, financial crises, global pandemics, and still managed to increase their shareholder payout year after year. That takes serious financial muscle, resilient business models, and management teams with a deep commitment to returning value to shareholders. These aren't speculative tech stocks. These are the bedrock of the American economy. But here's the hot take. It's not as simple as just buying any dividend aristocrat and expecting to win. That's where most people stumble. They see the list, pick a few names they recognize, and call it a day. That's a fundamentally flawed approach. Imagine going to a buffet and just picking the first thing you see, without checking if it's actually good or if it fits your dietary needs. That's what many investors do. They see Coca-Cola or Johnson on the list, buy it, and think they're set. And while those are fantastic companies, a truly optimized dividend aristocrat strategy, one designed to beat the market by 2026, requires a more nuanced, almost surgical approach. Some aristocrats are overvalued. Some are in declining industries. Some have taken on too much debt, making their future dividend growth shaky. If you just blindly pick, you're not optimizing, you're gambling. And in this market, you can't afford to gamble with your financial future. So how do we cut through the noise and identify the true champions for 2026? It comes down to 3 crucial selection criteria that most dividend chasers completely miss. First, financial strength. We're looking for companies with rock-solid balance sheets, low debt, high cash flow, and strong interest coverage ratios. Think about it. A company can only keep increasing its dividend if it has the money to do so. And that money comes from robust, consistent earnings and a responsible approach to debt. We want companies that aren't just surviving, but thriving financially, even when the economy gets rocky. This isn't about finding the flashiest growth stock. It's about finding financial fortresses. My personal bias? If a company is drowning in debt, even if it's an aristocrat, it's out. That dividend might look good now, but it's a ticking time bomb. Second, growth potential. This is where many dividend investors get it wrong. They only look at the yield, ignoring whether the company can actually grow its earnings and, by extension, its dividend. A stagnant company with a 3% yield isn't going to get you where you need to be. We need aristocrats that are still innovating, expanding their markets, and increasing their profits year over year. Look for companies with a history of strong earnings growth, expanding margins, and a competitive advantage that protects them from competitors. This could be a dominant market share, proprietary technology, strong brand loyalty, or efficient operations. If a company can't grow its earnings, eventually its dividend growth will slow to a crawl, or worse, stop. We want those dividend growers, not just dividend payers. And third, sustainable dividend yield. Notice I didn't say highest yield. A high yield can often be a red flag, indicating that the stock price has dropped significantly because the market expects a dividend cut. What we're looking for is a yield that's attractive, but more importantly, sustainable and likely to grow. A good rule of thumb is to look at the payout ratio, the percentage of earnings paid out as dividends. If a company is paying out 80% or more of its earnings as dividends, that's often too high and leaves little room for error or future growth. We want companies with a healthy payout ratio, say between 30% and 60%, allowing them to reinvest in their business while still consistently rewarding shareholders. This balanced approach ensures the dividend is safe and has room to grow, leading to greater capital appreciation alongside that juicy income. Now, even with the best selection criteria, the market is still a beast. Volatility is the only constant. We've seen markets crash and rebound, sometimes violently. Most investors, when they see red on their screens, panic. They sell low, lock in losses, and vow never to invest again. They let emotions dictate their decisions, and that's the fastest way to destroy wealth. This fear-driven selling is exactly what the smart money exploits. They know you'll bail at the bottom, and they'll scoop up those quality assets at a discount. But what if you could turn that market volatility to your advantage, almost systematically, and build your position stronger during those downturns? This brings us to one of the most powerful, yet overlooked, strategies for long-term wealth building, especially with dividend aristocrats: dollar-cost averaging. It sounds simple, almost too simple, but its effectiveness is profound. Here's how it works. Instead of trying to time the market, which, let's be honest, no one can consistently do, you invest a fixed amount of money at regular intervals, say every month or every quarter, regardless of whether the market is up or down. When prices are high, your fixed amount buys fewer shares. When prices are low, your fixed amount buys more shares. Over time, this averages out your purchase price and, crucially, allows you to accumulate more shares of quality companies during market dips. Think of it this way. When the market is down and everyone else is running for the hills, you're not just holding steady, you're actively buying more of those amazing dividend aristocrats at a discount. This means that when the market eventually recovers, and it always does, your portfolio is turbocharged with all those extra shares you bought cheap. It boosts your returns over time and takes the emotion out of investing. No more trying to guess the bottom. No more regretting that you didn't buy more when things looked bleak. You just stick to the plan. It's disciplined, it's consistent, and it works. This isn't some complex financial wizardry. It's just smart, patient investing that lets you capitalize on the market's irrationality. Here's my hot take, and this is where I fundamentally disagree with most of the mainstream financial advice out there. Everyone is too focused on the short term. They chase the latest meme stock, the hottest IPO, the next big thing, and they miss out on the incredible power of slow, steady, compounding wealth. They want to get rich quick, and they usually just end up getting poor quickly. The dividend aristocrat strategy, especially when combined with smart selection and dollar-cost averaging, isn't a get-rich-quick scheme. It's a get-rich-for-sure scheme, provided you have the patience and the discipline. This is about playing the long game, building a portfolio that generates consistent, growing income and beats the S&P 500 not through luck, but through fundamental strength and strategic execution. Wall Street wants you to believe investing is complicated, so you'll pay them exorbitant fees. They want you to be glued to your screen, reacting to every news headline. But the truth is, real wealth is built with boring, consistent action, not thrilling speculation. While everyone else is trying to hit a home run every quarter, we're out here hitting singles and doubles consistently, and those add up to a championship over time. The Wall Street rebel in me screams that most advisors don't even talk about this, because it's not exciting enough for their clients, and frankly, it doesn't generate enough trading volume. But for the informed, patient investor, it's a goldmine. By 2026, those who have patiently built their portfolios with these high-quality dividend aristocrats, consistently buying through thick and thin, we'll be looking at a portfolio that not only provides a robust, growing stream of income, but has also outpaced the broader market, often with less stress. Think about it. During market downturns, your dividend payments keep coming in, providing psychological comfort and even capital to reinvest. This isn't just about beating an index. It's about achieving true financial independence through a reliable, proven method. So how do you actually start building this powerhouse portfolio for 2026? You need to dig into the numbers. Look for companies like those in defensive sectors, consumer staples, healthcare, utilities, and even some industrials. These are the companies whose products people need, regardless of the economic climate. Think about companies that produce essentials, medicines, or maintain crucial infrastructure. They tend to have stable earnings and consistent dividend growth. We're talking about companies that have stood the test of time, proving their resilience. For example, some of the names that consistently show up with strong financials, growth potential, and sustainable yields are often overlooked by the high-growth crowd. We're not going to give you a full list right now, but trust me, there are some absolute gems out there that are perfectly positioned for the next few years. To give you a little taste, without giving away the farm, think about sectors like specialized industrial manufacturing that are crucial to other industries, or healthcare companies with strong patent portfolios and aging populations as a tailwind. Even some consumer staples that are innovating and expanding into new markets can be phenomenal choices. The key is to look beyond just the big, obvious names and find those aristocrats that are still flying under the radar, or those that have temporarily fallen out of favor but still have their fundamental strengths intact. Do your own research, but definitely keep an eye on these sectors. The real work isn't just finding an aristocrat, it's finding the right aristocrats that fit our strict criteria and offer that powerful combination of stability, growth, and income. This strategy isn't about getting lucky. It's about making intelligent, informed decisions based on time-tested principles. It's about ignoring the hype and focusing on the fundamentals. While everyone else is chasing the next big thing, you'll be quietly building a fortress of wealth, powered by the most reliable companies on the planet. By 2026, you won't just be keeping up with the S&P 500. You'll be looking down at it, with a portfolio that not only grows your capital, but pays you consistently along the way. That's the power of investing like a Wall Street rebel, ignoring the noise, and focusing on what truly works. Want to see my exact top Dividend Aristocrat picks for 2026? And how to build a portfolio step by step? Watch this video next.